Smurfing. Despite the name, this tactic has nothing to do with the little blue cartoon characters, at least not directly. The name comes from the idea of using lots of small people to move money around, just like a village full of Smurfs. These people are often called Smurfs. Instead of depositing a huge amount of dirty money all at once, the money is split into smaller amounts and given to multiple Smurfs. One Smurf might deposit money in New York, another in Chicago, another in Los Angeles. They may even use completely different banks. For example, instead of depositing $500,000 in one transaction, they might make 100 deposits of $5,000 each. The goal is simple: avoid attracting attention. Banks are trained to monitor unusually large transactions. One big deposit gets noticed. 100 small deposits often don't. Cash-intensive businesses. Cash-intensive businesses are businesses that naturally handle large amounts of cash every day. Restaurants, bars, nightclubs, car washes, laundromats. In fact, many people believe the term money laundering became popular because criminals use laundromats to mix dirty money with legitimate business income. Because cash is constantly flowing through these businesses, it becomes easier to mix dirty money with legitimate revenue. A restaurant that actually earned $5,000 today might report $10,000. The extra $5,000 didn't come from customers. It came from criminal proceeds. On paper, however, it looks like normal business income. Casino laundering. Casinos provide another opportunity to make dirty money appear legitimate. A criminal enters a casino with cash and purchases casino chips. They may spend some time gambling, win a little, or even lose a portion of the money in the process. But the goal isn't necessarily to make a profit. The goal is to create a legitimate explanation for where the money came from. After gambling for a short period, the remaining chips are exchanged back for money. Now the funds appear to come from gambling activity rather than their original source. In some cases, very little gambling happens at all. The chips are simply bought and later redeemed. This creates a paper trail that makes the money look cleaner than it actually is. Shell companies. A shell company is a company that exists mostly on paper. It may have no employees, no products, no real business activity, yet it can still have bank accounts and move money around the world. That's what makes shell companies so useful to money launderers. Imagine investigators are trying to find who owns a suspicious company. They discover that Company A owns Company B. Company B owns Company C. Company C is owned by another company in a different country, and that company is owned by another company. The deeper they dig, the harder it becomes to identify the real owner. In many cases, the true owner isn't even listed publicly. Instead, layers of paperwork, nominee directors, and other companies are used to hide who is actually controlling the money. The Panama Papers leak exposed thousands of offshore shell companies used by politicians, celebrities, billionaires, and criminals around the world. Crypto laundering. Cryptocurrency introduced an entirely new way to move money. Unlike traditional banks, crypto transactions can be made directly between people anywhere in the world. A criminal can convert dirty cash into cryptocurrency and then move it through multiple wallets within minutes. To make tracking even harder, some use crypto mixers. A mixer takes cryptocurrency from many different users, combines it together, and then redistributes it. The result is that tracing where the money originally came from becomes much more difficult. Others move funds between different cryptocurrencies multiple times. Bitcoin becomes Ethereum. Ethereum becomes Solana. Solana becomes another cryptocurrency. Each step adds another layer of complexity. The more wallets the money passes through, the harder it becomes to follow. While crypto is not completely anonymous, investigators often have to follow hundreds or even thousands of transactions before finding where the money originally entered the system. Think that's crazy? Subscribe. It gets worse. Hawala. Hawala is one of the oldest money transfer systems in the world. What's unusual is that the money often never actually moves. Let's say El Pablo wants to send $100,000 from New York to Don Carlos in Dubai. Instead of using a bank, El Pablo gives the money to a Hawala broker in New York. That broker contacts another Hawala broker in Dubai. The broker in Dubai then gives $100,000 to Don Carlos. No international bank transfer takes place. No money crosses a border. The brokers settle their debts between themselves later. The system relies heavily on trust and personal relationships, which is one reason it has existed for centuries. To be clear, Hawala itself is not automatically illegal. Millions of people use similar systems legitimately because they are fast, cheap, and accessible. The problem is that the same features that make Hawala useful also make it attractive to criminals. Trade-based laundering. Trade-based money laundering hides money inside ordinary international trade. Let's say a company in China sells a shipment of shoes worth $100,000 to a company in the United States. On paper, however, the invoice says the shoes are worth $1 million. The buyer pays $1 million. The seller keeps the extra $900,000. And just like that, money has been moved under the disguise of a legitimate business transaction. The opposite can happen too. Goods worth $1 million might be declared as worth only $100,000. Investigators call this over-invoicing and under-invoicing. Because millions of goods cross borders every day, spotting these fake prices can be extremely difficult. To customs officials, it might just look like another shipment. A container of shoes, a shipment of electronics, a truck full of furniture, but hidden inside the invoice could be hundreds of thousands of dollars moving from one country to another. Real estate laundering. Ever wondered why some luxury apartments, mansions, or office buildings seem completely empty? In some cases, money laundering may be part of the answer. Real estate has long been a popular tool for hiding wealth and cleaning dirty money. A criminal uses illicit money to purchase a house, apartment, office building, or piece of land. Once the property is owned, it can be sold later. Now the money appears to come from a legitimate property sale rather than its original source. In some cases, properties are bought through companies or third parties to make ownership harder to trace. Luxury properties are especially attractive because a single purchase can involve millions of dollars. And unlike carrying cash around, a building doesn't attract much attention. Some properties remain empty for years. No tenants, no families, no businesses, because the property's real purpose isn't necessarily to generate income. It's to store wealth and disguise where that wealth came from. Modern art laundering. Modern art might seem like a strange place to hide money, but that's exactly what makes it useful. Unlike stocks, houses, or cars, there is no universally agreed price for a piece of art. One person might say a painting is worth $5,000. Another might say it's worth $5 million. And neither can be proven wrong. A criminal can buy a piece of artwork, artificially inflate its value, and then sell it later. Imagine buying a painting for $20,000 using dirty money. A few years later, that painting is suddenly valued at $2 million. You sell it. Now, when someone asks where the $2 million came from, the answer isn't drug trafficking, fraud, or crime. The answer is, I sold a painting. The dirty money has been transformed into what appears to be legitimate income from an art sale. Same money, different story, and let's be honest. Modern art sometimes makes this even easier. A painting that looks meaningless to one person might sell for millions to another. A sculpture, a few brushstrokes on a canvas. Even ordinary objects have sold for astonishing amounts of money. Because value in the art world is often subjective, it becomes much easier to justify dramatic price increases that would look suspicious in almost any other market. Offshore accounts and tax havens. An offshore account is simply a bank account located in another country. On its own, there's nothing illegal about it. Millions of people and businesses use offshore accounts legitimately. Some countries are known as tax havens, places with strict privacy laws, low taxes, and limited financial transparency. Examples often include the Cayman Islands, the British Virgin Islands, Panama, and Switzerland. Money can be transferred into companies and accounts located in these jurisdictions, making it much harder for authorities to determine who actually owns it. In some cases, investigators spend years trying to trace money through dozens of companies spread across multiple countries. By the time they uncover one company, another layer appears behind it, and then another and another. Most banks follow strict anti-money laundering rules. This is one reason offshore accounts have appeared in countless money laundering investigations over the years. The money isn't necessarily hidden. The ownership is. And sometimes that's all a criminal needs. Not to hide the money, just to hide themselves. And that's the crazy part. Money laundering isn't about hiding money. It's about changing the story behind where that money came from. Every tactic we covered today is designed to do one thing: make dirty money look clean. And that's why governments spend billions of dollars every year trying to detect it. Because once money successfully enters the financial system, separating legitimate wealth from criminal wealth becomes incredibly difficult. If you enjoyed this breakdown, subscribe to Adam Wealth. Thanks for watching.